Assalamualaikum. We are from group N4CS1124D. Now we will present our group project TASK1. Our group member include myself, Ifa Oni binti Zakaria, Muhammad Anas bin Zaidi, Muhammad Shazri bin Ibrahim, Nur Syafiqah Syahira binti Rosman, and Nur Fahana binti Muhammad Fazil.
Hi, Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Syafiqah Syahira binti Rosman and my matrix number is 2020882042. I would like to explain the role of actuary in risk management control cycle with key component of IMMR. First, risk identification is recognized by using a top-down and bottom-up method. With the top-down approach, identifying risk at the entity level, and the bottom approach, identifying risk at the function level. Risk identification is most important during company planning, product pricing, and ongoing product management. Second, risk measurement. It's evaluated in the context of an organization's risk appetite. In reality, before risk is qualified, the risk appetite should be agreed upon the started clearly. The key techniques of risk measurement are calculation of economic capital, VAR, SST, and more. Third, risk management. Risk management is performed through transfer risk, risk removal, risk reduction, risk avoidance, and risk retention. Risk management is an important aspect of controlling residual risk and risk in the distribution extreme left tail.
Next, my name is Ifa Oni binti Zakaria. I will present about risk monitoring and risk reporting. Risk monitoring. Key risks are monitored through management information, monitor impact on key metrics such as economic capital, liquidity, and monitor early warning signals SST. Trend information and analysis of forecast. Risk monitoring helps in feedback loop to risk identification and risk management. Without this process, the risk management exercise will be incomplete. So this is a very important link in the risk management control cycle. Next is about risk reporting. Risk reporting is performed by informing the key stakeholders such as senior management board and board subcommittees such as ELCO, risk management committee regulator, rating agencies, and policyholder or bank customers. I will continue with key risks in life insurance. I will explain about insurance risk. There is 4 risks in insurance risk. First, mortality risk. Mortality risk is the risk associated with the variability in liability cash flows due to the incidence of death. Level, trends, volatility, and catastrophe risk components are calculated for all individual and group life insurance products that are exposed to mortality risk. Second, morbidity risk. Morbidity risk is the risk associated with the variability in liability cash flows arising from the incidence of policyholder disability or health claims, including critical illness, and from termination rates. Third, lapse risk. Lapse risk is the risk associated with the variability in liability cash flows due to the incidence of policyholder lapse and other policyholder behavior. Lapse risk include risk arising from options that allow policyholder to fully or partially terminate an insurance contract. And the last one is expense risk. Expense risk is the risk associated with the unfavorable variability of expenses incurred in servicing insurance or reinsurance contracts. The example is the variability in expense liability cash flows due to the variation of the in-force policies, excess claims, lapse, and surrenders.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Shazri bin Ibrahim. Now we will move on to the key risks in life insurance for the financial risk. The first one is market risk, which is the risk due to the financial fluctuations. The second one is interest rate risk, which is the risk associated with any contractual agreement or financial transaction. The third one is equity risk, exposure to uncertainty due to the changes in rate or market price of an invested asset. The fourth one is foreign exchange risk. It refers to the loss that an international financial transaction may incur due to the fluctuations. The fifth one is liquidity risk, which is the risk that an insurer has inadequate cash to meet obligations as they come due. And the last one is credit risk, the risk of losses due to the failure of counterparty. And now we will move on to the operational risk. Operational risk is the risk of adverse change in the value of capital resources resulting from operational events such as inadequacy or failure of internal systems, personnel, procedures or controls, as well as external events. And the other risk is regulatory risk, the risk that a change in law or an regulation will significantly impact an institution. And then we have legal risk. Specific legal risk is the chance that a contract between two parties will be considered unenforceable under the controlling legal authority, while general legal risk involve situations where there is no clear legal authority. And the last one is catastrophe risk, a type of risk that could cause a large number of policyholders to file claims at the same time.
Hello, my name is Muhammad Anas bin Zaidi. I'm from CS112 4D. Now, I will proceed with key risks in banking sector. For credit risk, for bank, the most significant risk is credit risk because when debtors or counterparties fail to satisfy contractual commitment, it is known as the default. Then, borrowers defaulting on a loan principles or interest payment is an example. Then, liquidity risk. Liquidity risk the capacity of a bank to get funds to satisfy financing obligation is referred to as liquidity risk. Then, allowing a client to withdraw their deposit is one of the obligation. Lastly, inability to give funds to customer in a timely manner might have a snowball effect. And for the interest rate risk, interest risk refers to a bank's earning exposure to fluctuation in interest rate which influence asset and liabilities in various ways. Because they operate with mismatched balance sheet, banks are vulnerable to interest risk. Because bank expenses and revenues are increasingly linked to the market interest rate, calculating the net effect of interest rate fluctuation on bank profitability is becoming more challenging.
Hi, my name is Nofarhana binti Muhammad Fazil. Next, I will continue with market risk. Market risk is mostly associated with a bank's capital market activity. It is because equities market, commodities price, interest rate, and credit spread are all unpredictable. Commodity prices are important because a bank may have investment in a commodity producing companies. As the value of the commodity change, so does the value of the company and the value of the investment. Change in commodity price are caused by a supply and demand shift that are often hard to predict. Banks that participate extensively in capital market or conduct sales and trading are more vulnerable to market risk. Next, operational risk. The risk of loss due to errors, disruption, or damage caused by a people, system, or processes is referred to as operational risk. Simple commercial activities like retail, banking, and assets management have a minimal operational risk, but sales and trading have a large operational risk. fraud may occur on a wider scale when a bank's cybersecurity is breached. It enables hackers to steal customer information and money from banks, as well as blackmail them for more money. Lastly, the other risk is reputational risk. In the banking company, reputation is a very valuable intangible asset. JP Morgan, Chase, Citibank, and Bank of America, for example, have all been in business for hundreds of years and have impeccable reputations. Because of their reputations, they are able to create more business at a higher profit margin. Banks may protect their reputations by never engaging in any unethical or deceptive business activities. Furthermore, banks must always ensure that their public relations activities portrays them as a courteous and trustworthy institutions.